January 15th, 2026. A $14.5 billion announcement drops that makes every health tech executive in the world stop mid-coffee. Boston Scientific, a company that deliberately exited the brain surgery device business 15 years ago, just wrote the biggest check in its 45-year history to buy Penumbra, a company most people have never heard of. This isn't just another acquisition. This is a signal that the entire business model of medical innovation is being rewritten in real time.
And here's what makes it fascinating from a technology standpoint. We're not talking about some speculative biotech bet or a flashy AI platform. We're talking about mechanical devices that suck blood clots out of people's brains during strokes. Unglamorous, life-saving hardware that's been around for years. Yet Boston Scientific is paying 10 times Penumbra's annual revenue, a premium that would make even software investors blush.
To understand why this matters, you need to grasp what's actually changing in 2026. The era of scrappy medical device startups building billion-dollar businesses independently is ending. The capital requirements, regulatory complexity, and global distribution challenges have become so immense that even a company generating $14 billion in revenue like Penumbra hits a ceiling. They can't scale fast enough to meet demand without a giant's infrastructure.
So this isn't just about one deal. It's about a fundamental shift in how life-saving medical technology reaches patients. And the implications ripple far beyond two companies merging their balance sheets. It's time to understand this deeply.
Let's start with what Penumbra actually makes, because the technology itself is remarkable in its elegant simplicity. When someone has an ischemic stroke, a blood clot blocks an artery in their brain. Every minute that passes, roughly 2 million neurons die. The traditional approach was to inject clot-dissolving drugs and hope they worked fast enough. Penumbra's breakthrough was mechanical thrombectomy, essentially a catheter system that physically removes the clot. Their flagship Lightning Bolt 7 system, approved in 2024, can navigate through the twisting blood vessels of the brain, latch onto a clot, and extract it in a single pass. The clinical data from 2025 showed an 85% success rate in restoring blood flow within 90 minutes of treatment initiation. For context, that's the difference between a patient walking out of the hospital versus spending months in rehabilitation or not surviving at all.
And this isn't just brain clots. Penumbra's technology expanded into pulmonary embolisms, blood clots in the lungs that kill about 100,000 Americans annually. Their CAVD system, which stands for Computer-Assisted Vacuum Thrombectomy, uses real-time pressure monitoring to extract clots from lung arteries without damaging delicate tissue. By late 2025, they were treating deep vein thrombosis and peripheral artery disease, essentially becoming the Swiss Army knife of clot removal. The human impact becomes visceral when you look at the numbers. In 2025, Penumbra's devices were used in approximately 180,000 procedures globally. That's 180,000 people who faced catastrophic vascular events and had a technology available that didn't exist 2 decades ago. The American Heart Association's 2025 data showed that hospitals equipped with advanced thrombectomy capabilities reduced stroke mortality by 31% compared to those without.
But here's where Penumbra hit its growth paradox. Despite revenue climbing 21% in Q4 2025 to reach $1.4 billion for the year, they were still predominantly a North American company. About 68% of their revenue came from the United States. Europe represented maybe 22%, Asia Pacific barely 10%. Meanwhile, stroke incidence is rising fastest in China and India, where aging populations and changing diets are creating a vascular disease epidemic. Adam Elsesser, Penumbra's CEO who founded the company in 2004, faced a strategic bind, building distribution networks in 47 countries, navigating each regulatory system, training thousands of interventional neurologists and cardiologists on proprietary techniques, all while funding R&D for next-generation devices that requires capital and infrastructure that takes decades to build organically. Now flip to Boston Scientific's perspective, and you see a company executing one of the most aggressive portfolio transformations in medtech history. Mike Mahoney took over as CEO in 2012, inheriting a company that was strong in cardiac stents and pacemakers, but had divested its neurovascular business to Stryker back in 2011 for $1.5 billion. That decision, made during a period of patent expirations and cost-cutting, looked increasingly short-sighted by 2025, because while Boston focused on hearts, the neurovascular device market exploded. Mechanical thrombectomy became standard of care for large vessel occlusion strokes after landmark clinical trials in 2015. The global market grew from about $800 million in 2015 to an estimated $2.8 billion by 2025, with projections hitting $5 billion by 2030. Boston had zero presence in the fastest-growing segment of vascular intervention.
And Mahoney's response has been a buying spree that's remaking the company. In March 2025, Boston acquired Silk Road Medical for $1.2 billion, gaining access to TCAR, a technology for preventing strokes during carotid artery procedures. In November 2025, they bought Valencia Technologies, a neuromodulation startup, for an undisclosed sum rumored around $400 million. Each acquisition filled a specific gap in their vascular portfolio. But Penumbra represents something categorically different. This isn't a tuck-in acquisition of a technology or product line. This is buying the category leader, the company that essentially created and dominates mechanical thrombectomy. Penumbra holds approximately 32% global market share in neurovascular devices, second only to Stryker's roughly 38%. By acquiring Penumbra, Boston instantly becomes a major player, competing directly with Stryker and Medtronic in a market they had completely abandoned.
The strategic logic becomes clearer when you consider Boston's existing strengths. They have one of the most sophisticated global distribution networks in medical devices, with direct sales presence in over 130 countries. Their interventional cardiology franchise, which includes drug-eluting stents and imaging systems, generated about $4.2 billion in 2025. The physicians who perform cardiac catheterizations are often the same interventional specialists who perform thrombectomies. The customer overlap is nearly perfect. Boston's pitch to hospitals becomes transformative. Instead of buying cardiac devices from Boston and neurovascular devices from Penumbra or Stryker, they can consolidate vendors. For a hospital procurement officer dealing with budget pressures, having one contract, one set of negotiations, one training program, that's operationally attractive. The cross-selling potential is what analysts are valuing at $70 million to $140 million in annual synergies by 2028. Let's dissect the financial architecture of this deal, because the numbers tell a story about how Boston is betting on the future. The headline is $14.5 billion in total transaction value, with Penumbra shareholders receiving $374 per share. That represents a 23% premium over Penumbra's closing price on January 14th, the day before announcement. The structure is 73% cash and 27% Boston Scientific stock, giving Penumbra investors about $273 in cash and 0.98 shares of Boston stock per share they own. Boston is funding the $11 billion cash component through a combination of $2.8 billion in existing cash and roughly $8.2 billion in new debt financing. Investment banks led by J.P. Morgan and Goldman Sachs have committed to providing bridge loans that Boston will refinance into long-term bonds. This pushes Boston's leverage ratio, the measure of debt relative to earnings, from about 2.1 times EBITDA to approximately 3.3 times. That's elevated but manageable for a company generating nearly $15 billion in annual revenue.
And here's where the valuation gets interesting. At $14.5 billion for a company with $1.4 billion in 2025 revenue, Boston is paying a multiple of roughly 10.4 times sales. For context, Boston Scientific itself trades at about 5.2 times sales. Stryker, a peer, trades around 6.8 times, so Boston is paying a massive premium. Why? The answer is growth trajectory and market position. Penumbra's revenue grew 19% in 2024 and accelerated to between 21% and 22% in Q4 2025. Most of Boston's existing businesses are growing at mid to high single digits. By acquiring Penumbra, Boston is buying a growth engine that's expanding twice as fast as their core portfolio. If Penumbra can sustain even 15% annual growth, that $1.4 billion becomes $2.3 billion by 2028, making the valuation multiple look more reasonable.
Plus, there's the competitive dynamics. If Boston doesn't buy Penumbra, someone else likely would. Medtronic was reportedly considering a bid in late 2025, but couldn't match Boston's offer due to its own debt load from previous acquisitions. Stryker could have been a buyer, but antitrust regulators would almost certainly block a deal between the number 1 and number 2 players in neurovascular. Boston had a unique window where they were both willing and able to pay up. The deal structure also includes some clever risk management. There's a $525 million breakup fee that Penumbra would pay Boston if the deal falls apart due to Penumbra's actions, and a $900 million reverse breakup fee that Boston would pay if regulatory approvals fail. That asymmetry reflects Boston's confidence that antitrust clearance will proceed smoothly since they currently have zero overlap with Penumbra's products. Now, let's address the financial reality that gets buried in press releases. This deal will be dilutive to Boston's earnings per share, meaning it will reduce reported profits in the short term. Boston CFO guidance projects dilution of 6 cents to 8 cents per share in the first year post-close, which is expected in the second half of 2026. That's roughly a 1.5% hit to earnings. Year 2, the deal becomes neutral. By year 3, it turns accretive, adding to earnings. This J-curve pattern is standard in large acquisitions and stems from 2 factors. First, purchase accounting rules require Boston to amortize the $14.5 billion purchase price, creating non-cash charges that flow through the income statement. Second, integration costs, like consolidating facilities, harmonizing IT systems, and redundancy elimination, hit immediately, while revenue synergies take 18 to 24 months to materialize.
But here's the aspect that matters more than reported GAAP earnings. Boston is betting that the cash flow generation from Penumbra's business, combined with synergies, will allow them to delever aggressively. Their stated goal is to bring that 3.3 times leverage ratio back down to 2.5 times within 2 years. That requires generating about $3.5 billion in cumulative free cash flow and directing it toward debt repayment. It's achievable if the integration goes smoothly, but it leaves little margin for error. And this is where the human element becomes critical. Large M&A deals in healthcare fail not because of financial miscalculations, but because of cultural integration disasters. Medtronic's $50 billion acquisition of Covidien in 2015 struggled for years with integrating disparate sales forces and product portfolios. Johnson & Johnson's $21 billion purchase of Synthes in 2012 was plagued by culture clashes between the entrepreneurial Swiss company and J&J's corporate bureaucracy.
Penumbra's culture is notoriously entrepreneurial. Adam Elzesser, the founder and CEO, is a charismatic engineer who maintains tight control over product development and strategic direction. The company operates with a startup mentality despite its size, making rapid decisions and iterating quickly on device designs. Boston Scientific, by contrast, is a 46-year-old public company with formal processes, compliance layers, and a matrix organizational structure. The retention of Elzesser is both a strength and a risk. As part of the deal, he's taking his entire $374 per share consideration in Boston stock rather than cash, and he'll join Boston's board of directors. That aligns his incentives with Boston's success and signals confidence, but it also creates a potential governance tension. Will Elzesser have real influence over how Penumbra is integrated, or will he become a figurehead while Boston's operational leaders make the actual decisions?
Let's zoom out and consider what this deal signals for the broader health tech innovation ecosystem, because the implications are profound. Penumbra was founded in 2004 with venture capital funding, went public in 2015, and spent 11 years as an independent public company building its business. That's a relatively rare trajectory in today's environment. The question every entrepreneur and VC is now asking is, can that path still be replicated, or is the window closing? The data from 2025 paints a challenging picture. According to Rock Health's year-end report, digital health funding dropped 32% in 2025 compared to 2024, continuing a downward trend from the 2021 peak. But medical device funding held steadier, declining only 11% because devices have clearer regulatory pathways and reimbursement models. Yet, even in devices, the capital required to scale from prototype to billion-dollar business has become staggering.
Consider the economics of building a thrombectomy device company today. You need about $50 million to $80 million just to get through FDA clinical trials and 510(k) clearance for your first product. Then you need a direct sales force, because these devices require in-person training and support. Interventional radiologists and neurologists won't adopt a complex catheter system based on a brochure. Building a U.S. sales team of 150 reps costs roughly $40 million annually in salaries, commissions, and expenses. Then there's the international expansion challenge. Each major market, Europe, Japan, China, requires separate regulatory submissions, clinical data packages, and reimbursement negotiations. Penumbra spent over a decade building this infrastructure. A startup today either needs to raise $500 million plus in venture capital, which is virtually impossible for a device company, or they need to partner with or sell to a strategic acquirer early. The independent growth path is narrowing.
And this is where the power dynamics shift in favor of the giants. Boston Scientific, Medtronic, Stryker, Abbott, Johnson & Johnson. These companies are sitting on record amounts of cash and have access to cheap debt financing. Boston's borrowing cost for the Penumbra acquisition is estimated at around 5% interest. For them, spending $14 billion to acquire growth is actually cheaper than trying to organically develop competitive products, which could take 8 to 10 years and still fail. So, the strategic calculus for startups changes. If you're a founder developing a novel vascular device, you're now building with the explicit goal of being acquired within 5 to 7 years. You optimize for demonstrating clinical efficacy and early commercial traction, knowing that scaling to $500 million or $1 billion in revenue independently is functionally impossible without strategic partnership. Innovation becomes modular. Plug-and-play components that the giants assemble.
Let's talk about the regulatory approval process, because while Boston and Penumbra executives express confidence, there are legitimate questions about whether this deal sails through unchallenged. The primary hurdle is Hart-Scott-Rodino antitrust review, where the Federal Trade Commission and Department of Justice assess whether the merger substantially lessens competition. The filing was submitted in late January 2026, triggering a 30-day initial review period. Boston's argument is straightforward. They currently have zero market share in neurovascular thrombectomy devices. Penumbra's main competitors are Stryker, with about 38% share, and Medtronic, with roughly 18%. Post-acquisition, the competitive landscape would be Stryker at 38%, Boston Penumbra at 32%, and Medtronic at 18%. That's a three-player market, concentrated but not monopolistic. No single entity would control more than 40%, which historically has been a threshold where regulators become aggressive.
But here's the complication. The FTC, under Chair Lina Khan, who remains in her position as of January 2026, has taken an expansive view of antitrust enforcement. The agency has challenged mergers not just on current market overlap, but on potential future competition and vertical integration concerns. Could the FTC argue that Boston, with its massive cardiology presence, could have entered neurovascular independently, and by buying Penumbra, they're eliminating that potential competition? It's a stretch legally, but not impossible. The FTC blocked Illumina's acquisition of Grail in 2021 on a vertical integration theory, even though Illumina was a supplier to Grail, not a direct competitor. That case ultimately failed in court, but it signaled the agency's willingness to test novel theories. If the FTC decides to issue a second request, an in-depth investigation demanding millions of pages of internal documents, that could delay the deal by 6 to 12 months.
Boston has structured the deal with this risk in mind, hence the $900 million reverse breakup fee. That's a meaningful sum, roughly 6% of the transaction value, designed to compensate Penumbra shareholders if regulators block the deal. It also signals to the FTC that Boston is serious and willing to litigate if necessary. The company's legal team, led by outside counsel from Wachtell, Lipton, has a strong track record in merger litigation. The other regulatory consideration is international. In Europe, deals above certain thresholds require European Commission review. China's State Administration for Market Regulation also has jurisdiction over transactions involving companies with significant Chinese revenue. Penumbra's China business was about $110 million in 2025. Small, but growing. Any one of these regulators could impose conditions like divesting certain product lines or maintaining separate operations that complicate the integration.
Let's bring this back to the human level, because ultimately, this deal's success or failure will be measured in patient outcomes and physician adoption. For a neurologist working in a comprehensive stroke center in 2026, the consolidation of vendors creates both opportunities and concerns. On one hand, having integrated vascular solutions from a single company simplifies procurement, training, and technical support. Imagine a scenario where a patient arrives with both a cardiac issue and a stroke. Currently, the interventional cardiologist might use Boston Scientific stents for the heart and then hand off to a neurointerventionalist using Penumbra catheters for the brain. Post-merger, the entire procedure could potentially be managed with a unified platform, shared imaging systems, and coordinated care protocols. That's the vision Boston is selling, a seamless continuum of vascular care.
But physicians also value choice and competition. If Boston Penumbra becomes one of only 3 major players in neurovascular, and if they start bundling products, forcing hospitals to buy cardiac and neuro devices together to get volume discounts, that reduces physician autonomy. Some interventionalists prefer Stryker's aspiration catheters for certain clot types, Penumbra's systems for others. Consolidation could lead to standardization that doesn't serve every patient equally. There's also the innovation question. Penumbra's most significant recent breakthrough, the Lightning Bolt 7 system, came from their willingness to iterate rapidly on catheter designs based on physician feedback. They'd release a new version, gather data from 50 procedures, tweak the design, and release an updated version within months. That agility is harder to maintain within a large organization where product development goes through multiple approval layers and risk committees.
The counterargument is that Boston's resources could accelerate innovation. Penumbra spent about $180 million on R&D in 2025, roughly 13% of revenue. Boston spent $1.6 billion, about 11% of their much larger revenue base. If Boston allocates even a fraction more capital to neurovascular R&D, Penumbra's engineers could pursue projects that were previously too expensive or risky. The question is whether bureaucracy neutralizes the capital advantage. For patients, especially those in underserved markets, the deal could be transformative. Boston's distribution network reaches hospitals in Southeast Asia, Latin America, and Sub-Saharan Africa where Penumbra had minimal presence. A stroke patient in rural Thailand or coastal Kenya might gain access to mechanical thrombectomy for the first time because Boston can justify the logistics of serving those markets at scale. That's not hypothetical. Boston's emerging markets revenue grew 14% in 2025, faster than developed markets.
Let's return to the financial structure, because there's an aspect of this deal that creates vulnerability for Boston. After closing, the company will be carrying approximately $22 billion in net debt. That's a substantial load for a company with about $15 billion in annual revenue and roughly $4 billion in EBITDA. The interest expense alone will be around $1.1 billion per year, consuming about 28% of operating earnings. This debt burden limits Boston's strategic flexibility. If another attractive acquisition target emerges in 2027 or 2028, a company that could fill a gap in their portfolio, Boston won't have the financial capacity to pursue it unless they've made significant progress paying down debt. It also makes them more vulnerable to macroeconomic shocks. If interest rates rise unexpectedly or if a recession reduces procedure volumes, Boston's coverage ratios could deteriorate quickly.
And there's a scenario that keeps CFOs awake at night. What if the integration takes longer than expected, synergies don't materialize as quickly, and Boston misses its deleveraging targets? Credit rating agencies Moody's and S&P currently have Boston at investment-grade ratings. Downgrade to junk status would increase borrowing costs and potentially trigger covenants in their debt agreements. It's unlikely, but not impossible, if multiple things go wrong simultaneously. The equity market's reaction has been mixed. Boston Scientific stock dropped about 4% on the day of the announcement, wiping out roughly $5 billion in market capitalization. Investors were concerned about the dilution, the debt load, and the execution risk. Penumbra's stock jumped 19% to near the $374 offer price, a typical merger arbitrage reaction. But the spread between Penumbra's trading price and the offer price has remained around 2%, suggesting some lingering doubt that the deal closes as structured.
Analyst opinions are divided. Stifel's healthcare team published a note calling the deal strategically brilliant but financially stretched. J.P. Morgan's analysts were more optimistic, projecting that the combined entity could grow revenue at 9% to 11% annually through 2030, well above Boston's standalone growth rate. The bear case focuses on execution risk and debt, the bull case on market position and cross-selling. Both narratives have merit. What's undeniable is that Boston is making a bet the company wager on vascular medicine as the growth engine for the next decade. They're pivoting away from being primarily a cardiac rhythm management company, which faces commoditization pressures, toward being a comprehensive vascular intervention leader. If it works, Mike Mahoney will be remembered as the CEO who transformed Boston Scientific. If it doesn't, he'll be remembered for the $14.5 billion mistake.
step back and look at the broader pattern, because this deal is part of a larger consolidation wave reshaping medical technology. In 2025 alone, we saw Abbott acquire Cardiovascular Systems Inc. for $890 million, Stryker buy a majority stake in Nico Corporation for an undisclosed sum, and Medtronic acquire Affera for $925 million. The mega Ds are getting more frequent and larger. The strategic logic is consistent across all these transactions. The big five medtech companies, Boston Scientific, Medtronic, Abbott, Stryker, and Johnson & Johnson, are competing for the same hospital customers and facing similar pressures: pricing scrutiny, regulatory complexity, and the need for constant innovation. They've concluded that organic R&D is too slow and risky. Buying growth through acquisition is faster and more predictable, even at premium valuations.
This creates a self-reinforcing cycle. As the giants acquire the most promising growth companies, the remaining independent players face even steeper challenges competing. Hospitals increasingly prefer to consolidate vendors, giving contracts to companies that can provide comprehensive solutions across multiple specialties. A startup with a single innovative device struggles to get hospital committee time when they're competing against Boston Scientific, offering a full vascular portfolio. The venture capital response has been to shift strategy. Instead of funding companies to become independent public companies, VCs are now explicitly building companies to be acquired within 5 to 7 years. The pitch to LPs, the pension funds and endowments that invest in venture funds, is that medtech offers more predictable exits than software or biotech. If you can get a device through FDA approval and demonstrate $50 million to $100 million in revenue, one of the big five will buy you at a decent multiple.
But this model has downstream consequences for innovation. If every startup is optimizing for acquisition by a strategic buyer, they're not swinging for the fences with truly disruptive technologies that might cannibalize existing product lines. They're building incremental improvements, Me Too devices with slight advantages, that are attractive to acquirers but don't fundamentally change patient care. The radical innovations, the ones that make existing treatments obsolete, become less likely. There's also a geographic dimension. The consolidation is heavily US and Europe-centric. Chinese medtech companies like Microport, Lepu Medical, and Sino Medical are growing rapidly but remain regional players. They're acquiring smaller Chinese startups but haven't made major Western acquisitions yet, partly due to regulatory barriers and partly due to technology gaps. If the Western giants continue consolidating while Chinese companies grow organically, we could see a bifurcated global market by 2030.
Let's game out 3 scenarios for where this all leads by 2028, because the trajectory isn't predetermined. Scenario 1, the bull case: Boston successfully integrates Penumbra, achieves the projected synergies, and the combined neurovascular and cardiac business grows revenue at 10% annually. The stock rebounds to $135 to $145 per share. Debt is paid down to 2.6 times EBITDA, and Boston regains strategic flexibility to make smaller acquisitions. In this scenario, Penumbra's technology reaches millions more patients globally. Stroke mortality rates decline measurably in countries where Boston expands distribution. Adam Elsesser remains actively involved, maintaining Penumbra's innovative culture within a semi-autonomous unit. Competitors Stryker and Medtronic are forced to respond with their own acquisitions, further consolidating the market. By 2028, the top 3 companies control 85% of the neurovascular market.
Scenario 2, the base case: integration proceeds adequately but not spectacularly. Boston achieves about 70% of projected synergies, growing revenue at 7% to 8% annually. Some key Penumbra engineers and sales leaders leave for competitors or startups, creating modest brain drain. The stock trades sideways between $105 and $115. Debt comes down slowly to 2.9 times EBITDA. Boston remains a strong player, but doesn't achieve market leadership. In this scenario, patients see incremental improvements in access and outcomes, but no dramatic breakthroughs. The pace of innovation slows slightly as Penumbra's product development gets absorbed into Boston's slower processes. Hospitals benefit from vendor consolidation, but complain about reduced negotiating leverage. Smaller startups struggle to compete, and venture funding for neurovascular devices dries up. The market becomes stable but less dynamic.
Scenario 3. The bear case. Integration hits major roadblocks. Cultural clashes lead to executive turnover, including Adam L. Sesser leaving the board within 18 months. Key Penumbra salespeople defect to Stryker, taking relationships and market share with them. Boston misses synergy targets, and the deal remains dilutive through 2027. The stock falls to $85 to $95. Debt stays elevated at 3.1 times EBITDA, constraining growth investments. In this scenario, the FTC imposes unexpected conditions during the approval process, like requiring Boston to license certain Penumbra technologies to competitors, undermining the strategic rationale. Hospitals push back on bundling, demanding the ability to cherry-pick devices from different vendors. A recession in late 2026 reduces elective procedure volumes, hitting revenue. By 2028, activist investors are calling for Boston to spin off Penumbra or find a buyer for the combined neurovascular unit.
As we approach the expected close date in the second half of 2026, several critical questions remain unresolved, and the answers will determine which scenario unfolds. First, how will Boston structure Penumbra operationally? Will it be a separate business unit with its own P&L and significant autonomy, or will it be fully integrated into Boston's existing vascular division? The press releases have been vague, using phrases like "operate with appropriate independence," which could mean anything. Second, what happens to Penumbra's R&D pipeline? The company had at least 6 devices in various stages of development as of late 2025, including next-generation thrombectomy systems and novel embolization technologies. Will Boston accelerate these programs with additional funding, or will some get deprioritized because they don't fit the portfolio strategy? The fate of these pipeline assets could determine competitive positioning for years.
Third, how aggressive will Boston be with cross-selling? If they push too hard, demanding that hospitals buy cardiac and neurovascular devices together to get favorable pricing, they risk backlash from physician groups and potentially antitrust scrutiny. But if they're too passive, they won't capture the synergies that justify the premium valuation. Finding the right balance requires nuanced execution that's difficult to predict from outside. Fourth, what's the competitive response? Stryker, which currently leads the neurovascular market, isn't going to passively watch Boston become a major threat. They have about $4 billion in cash and borrowing capacity to make acquisitions. Medtronic, despite its own debt challenges, could pursue strategic partnerships or licensing deals to bolster its neurovascular position. The competitive dynamics will shape whether Boston's market share gains come easily or through expensive battles.
And finally, the wild card. What technological disruptions could emerge that change the entire competitive landscape? What if a startup develops a pharmacological approach to clot removal that's as effective as mechanical thrombectomy but non-invasive? What if AI-guided robotic systems enable general hospitals to perform procedures that currently require specialized stroke centers? Medtech is historically slower to disrupt than software, but it's not immune. Boston is betting $14.5 billion on the current paradigm remaining dominant for the next decade.
So, what should entrepreneurs, investors, and healthcare leaders take away from this seismic deal? The fundamental lesson is that the barriers to building independent, scaled medical device companies have never been higher. The capital intensity, regulatory complexity, and global distribution requirements favor consolidation. If you're founding a medtech startup in 2026, you need to be realistic about the endpoint. That doesn't mean innovation is dead. It means innovation is becoming modular. Build a breakthrough technology, prove it works clinically, demonstrate early commercial traction, and position yourself as an attractive acquisition target. Optimize for speed to proof of concept. Rather than building a fully integrated company, partner with strategics early, even if it means giving up some control, to access resources and distribution.
For investors, the message is that medtech returns will increasingly come from M&A exits rather than IPOs. The public markets have limited appetite for small-cap medical device companies with $200 million to $500 million in revenue. They want large, diversified players with predictable cash flows. That means VCs need to underwrite investments with clear acquisition pathways, identifying which of the big five would be the logical buyer and why. For healthcare systems and physicians, the consolidation trend demands vigilance. Vendor concentration can lead to pricing power and reduced innovation. Hospital purchasing coalitions need to maintain competitive tension by credibly threatening to shift volume if any single vendor becomes too dominant. Physicians should advocate for maintaining clinical choice and push back against bundling arrangements that limit their ability to select the best device for each patient.
And for patients, the ultimate beneficiaries of medical innovation, the consolidation has mixed implications. In the near term, it could expand access as companies like Boston leverage their global reach to bring technologies to underserved markets. But in the long term, reduced competition could slow the pace of breakthrough innovations. The challenge for policymakers is fostering enough consolidation to achieve scale efficiencies while preserving enough competition to drive continued innovation.
The Boston Scientific Penumbra deal, announced on January 15, 2026, is more than a $14.5 billion transaction. It's a marker of a fundamental shift in how life-saving medical technologies are developed, commercialized, and delivered to patients. The era of independent venture-backed device companies, scaling to multi-billion-dollar public companies, is giving way to an oligopoly model where giants acquire growth and innovation rather than building it organically.
This isn't inherently good or bad. It's a structural evolution driven by economic realities. The escalating costs of R&D and regulatory approval, the complexity of global distribution, and the pricing pressures from healthcare systems. Boston Scientific is making a calculated bet that they can integrate Penumbra's entrepreneurial innovation culture with their operational scale to create something more valuable than either company could achieve independently.
Whether that bet pays off will become clear over the next 24 to 36 months as integration proceeds and synergies either materialize or disappoint. But regardless of the outcome for these two specific companies, the deal sets a template. Expect more mega deals in 2026 and beyond as the remaining independent medtech players either scale through acquisition or get acquired themselves. The landscape is consolidating, and the window for alternative paths is narrowing.
For everyone building, investing in, or using medical technology, the imperative is to understand these dynamics deeply. The rules of the game have changed. Success requires adapting to a world where innovation is increasingly a component that gets assembled by giants rather than a standalone force that challenges incumbents. That's the new reality of health tech in 2026.
Here at Deeply, we'll continue tracking how this mega deal unfolds and what it means for the future of medical innovation. We explore these transformative stories every day across technology, healthcare, and beyond, helping you understand not just what's happening, but why it matters and where it's heading. New episodes daily, diving into the forces reshaping our world.
Thanks for going deep with us today. Until next time, keep questioning, keep learning.
Stay curious. This has been Deeply,